Hello everyone, welcome to another video. And in this video we are basically going to discuss chapter 12, the second part of the chapter 12, and we're gonna continue um, with the second point, which is history doesn't account for structural changes when it comes to financial strategies, and we're going to see how it actually doesn't keep track of the structural changes. So we're going to start off with an example of retirement investments, like for example things like 401k and a Roth IRA. These two things are basically more common in the US, but just to illustrate the point, we're still going to discuss them. So these two things are very recent. I mean, they are probably like a few decades old. So whatever financial advice you would give to someone regarding retirement, it would be way different from how it was half a century ago, for example, right? So there is this one example of how just looking at history cannot always help us, because things actually keep on changing quite a lot. Another example would be venture capital. Venture capital did not exist over 25 years ago, and the only thing an entrepreneur could do was to basically go to the banks to ask for funding, and those banks were not very imaginative, and they were very risk aversive. And that basically shows us that how startups work or how new companies are founded, uh, and uh, and that thing has basically changed over the last 25 years. It has changed quite a lot. Now, looking at the stock market, we could say that S&P 500 did not include any financial stocks back in the days, but now it's a good part of the S&P 500, the financial stocks. Um, Looking at the overall sector in the stock market, technology stocks were not a big thing in the stock market like 50 years ago, but now they make up to fifth of the index funds, which is quite a bit of change over the last 50 years. Now, if you look at recession used to be very common back in the 1800s. It used to be like every 2 years, but then it's changed from every 5 years to 8 years to 12 years now. And the reason behind that is basically back in the days, our economy used to rely a lot on heavy industry, and heavy industry was more prone to boom and bust and due to overproduction. And these days we have service industry, which is less prone to that kind of problem, and hence we have a reduction in recession frequency. And then we're gonna talk about Benjamin Graham, who was a famous author and wrote this book called The Intelligent Investor. And his book was admired by a lot of people, investors, and the reason being was that his book was very elaborate, and it listed practical steps to actually make some money. So he had a lot of formulas in that book that you could use to make money. And one of the few strategies in his book was that you should buy the stocks which were trading less than their net working assets. And that this advice or this tactic might have worked back in the days, but these days you don't find many stocks which are less than their net working assets, and they're not easily available. They're not very cheap. Nothing is cheap anymore, basically. Another advice from his book was to avoid stocks trading higher than 1.5 percent, not percent. Uh, so he was basically saying to avoid stocks that were trading 1.5 times higher than their book value. But that advice as well is kind of ineffective, because if you go by that logic, you would only be investing in bank stocks or some insurance stocks, I guess. Um, and another thing is his book, even though it was very good, it listed quite a few useful strategies, but there was a limit to how much money you could make from those strategies, and there was also a limit on for how long those strategies were effective. So what usually used to happen was that people would caught up to those ideas and those strategies, and the more people actually use them, the more ineffective they become. Because in order to make money in stock market or investing, you need a little bit of edge from the rest of the people. And that is the reason that his strategies and his formulas became ineffective after some time. And that is the very reason that he kept on changing uh, his formulas in every new edition that he published of that book. So between 1934 and 1972, he changed the formulas 5 times. And this is another example of how things actually change over time when it comes to investing and economics. So the main idea here is the further back you will look in history, the more irrelevant or more obsolete the information becomes to current day when it comes to investing, at least. And what we can do to counter that is to basically look at the more recent history, which can actually help us make better decisions. But even if you decide to look at like history, like if you want to go back further back into the history, and the things I think, or the author thinks that you can actually learn from that history is basically the general stuff. The general stuff like how people respond to greed and fear, how do people handle stress, and how do they actually respond to incentives. Those are the things that we can learn the further back you go into the history, because they don't change very much. And as you can see, they are more related to human nature. And I suppose it's really hard to change human nature, how we behave. Um, so, the things that you should not look at when it comes to analyzing the history is you have to be careful about specific trends. You have to be very careful about specific trades, and you also have to be very careful about how people or what people do with the money, because these things, the trends, the trades, and people's behavior when it comes to investing their money, it's an ever-changing process. It's evolving all the time, and these are the things that we should not uh, base our decisions on when it comes to going further back into the history. So this is chapter 12, second part. Hopefully you learned something, and I will see you in the next one.